I think, look, at banking has to evolve. It can't just be taking deposits and lending money. That's somewhat of an antiquated model. Yeah, I think other countries have found ways to evolve. We fall behind, I think, because of our complex regulatory structure. But I do think that people want to be banks, but not traditional banks, is how I look at it. They want to redefine what it means to be a bank.
The current regulatory regime in the U.S. promised a lighter touch and, well, more de novo charters. Sure enough, there has been a flurry of activity with a wide range of applications being submitted, from longtime payment providers like PayPal, neobanks like Mercury looking to break free from their bad sponsors, and even Silicon Valley insiders looking to build the bank of the future like Erebor. Reading through the various applications and hearing the varied business plans, I had a question. Very fundamental question. Stick with me here. What if we're issuing bank charters to companies that don't actually want to be banks? We tend to treat a charter like the finish line, as if the moment you get one, you've crossed into some kind of higher state of legitimacy. But a charter is a regulatory status. Being a bank is an economic role. And those two things, well, are they drifting apart? In this episode, we dig into that tension. I'm joined by Jeff Taft, partner at Mayer Brown, who's advised on bank formations, regulatory strategy, and some of the most complex de novo and specialty charter conversations in the market. I was dying to ask him this question. Jeff has a front row seat to how applicants think about charters and how regulators evaluate whether they're actually ready to operate as banks. This conversation was recorded live as part of the FinTech Exchange put on by the FinTech Center at the University of Utah. The entire Hot Take series is powered by US Bank. Now let's dig into the question. Are most charter applicants trying to become banks or just trying to be regulated? Next on Breaking Banks. Jeff Taft, partner at Mayer Brown, joining me to talk today about a very nerdy and very specific topic. I was asked last night, is recording the podcast like, hey, at FinTech Exchange, powered by US Bank, doing our hot takes, why do you do it? Because I get to ask experts like you questions that are on my mind. Now, maybe this is a judgment on me, but with the rush of, new applicants looking at the door of getting a charter, right? Like de novos are back in vogue in applications. The question is why? This is something that keeps me up at night, is wrestling starting with how many of these actually new applicants want to be a bank versus is there another motivation? So why don't we start with, because you've been in this space for a long time, does it feel different, the number of entrants that are wanting to go through the charter process in terms of what their motivation is?
Yeah, I think there's a lot of pent-up demand, obviously, for charters. We haven't had a lot of new charters, quite frankly, since the financial crisis. And what we're seeing now is a number of, fintechs, but not only fintechs, a number of companies coming forward to get banking charters. And I think there's different motivation depending upon what type of business you want to do. But when I think about it, most of them are looking at a couple of different models. And the model that I think they're running away from is being highly regulated at the state level.
Okay.
People getting 50 state licenses to do lending, people, getting 50 state money transmitter licenses to do payments work. You get a bank charter that kind of simplifies it. You've got one or two regulators that you can, work with instead of all the 50 states. Now, what people don't realize, and this is, I think, goes to your point, is that one regulator you're getting could be very much as onerous, if not more onerous, than the 50 state regulators.
That is interesting, because I was coming at it thinking through the lens of partner banking. And is this a way to extract away another layer, right? Like being arm's distance from your regulator, as opposed to having a direct relationship and some of the latitude that could give, which I think also raises the question, if you're an entrant that today has a quasi-regulator in your bank partnership, do you think a lot of these new entrants really realize what it takes to be a regulated entity, especially at a national level?
Right. I think they underestimate both the time, the cost, and the restrictions on their business models. They're all working in a fairly unregulated environment. I know many of them have 20, 30, 40, 50, 60 state licenses to maintain the bank partnership program, but they don't have that overarching supervision examination on a regular basis. They're not holding, capital. There's a lot of things that come along with being a bank that I think people don't appreciate until they get the charter and they start to operate the business.
So in the business model of banking, which parts do you think they're not really appreciating how difficult it is? That, everything from the capital requirements you mentioned, Basel II, like there's all of this other stuff in the business of being a bank that is more than just being regulated that they don't anticipate.
Right. I think everybody understands what I would consider to be, consumer protection regulation because they've seen it in their current experience. They've seen it in their real life experiences. What they don't understand is prudential supervision. That's what we call safety and soundness regulation, making sure that you have policies, procedures, you follow those policies, procedures, you get supervised, you get examined on a regular basis. You have to hold capital against your loans. So if you have loan losses, there's something that buttresses those losses. That type of supervision, I don't think is something that people have a appreciation of until they get into the business. And then sometimes it's a little too late.
So question on this, because it feels like in some of the conversations I'm having, that these fintechs really want the charter. They don't want to be a bank. And by being a bank, I mean taking in deposits on one hand, lending on the other, right? The traditional model that was created to create fractional, the banking system we enjoy today and what that's grown. Do you think we need specialty charters, whether a narrow charter, a payments charter? Like, where do you fall on that spectrum? Are we trying to cram too much into one thing?
I think one of the problems we have in this system we have is we have a very fractured regulatory regime. We have a number of federal regulators. We have 50 state banking regulators. And part of that just goes back to the fact that we have what we call a dual banking system, right? We have state charter banks and federal banks. And as we subdivide the federal banks between trust companies, credit card banks, and special niche banks, whether it's a payment charter or something like that, I think we're even more fractionalizing the system. I think, look, at banking has to evolve. It can't just be taking deposits and lending money. That's somewhat of an antiquated model. Yeah, I think other countries have found ways to evolve. We fall behind, I think, because of our complex regulatory structure. But I do think that people want to be banks, but not traditional banks, is how I look at it. They want to redefine what it means to be a bank.
In that redefinition of what it means to be a bank, let's pull on that thread a second. Do you think many of them think about? What is it they actually aspire to be?
I think we still have a pretty high bar and a high regard for banks. So I think getting a banking charter almost conveys some sort of seal of good standing around your business. You're a bank. You're highly regulated. You must be trustworthy. All of the things that
safety and soundness, I assume.
I don't have to worry about my money with you. And if you do something wrong, I can go to your regulator. So I think there is some imprimatur of good standing that comes with getting a bank charter. So I think that's one of the reasons people want to be banks. I think there's also, that's a way that they can deliver some of the financial services that they want. It's not the only way, but it may be, going back to the model, that the state model and the like, that may be one of the easier ways, at least up front, it looks easy, right?
So back to the unanticipated consequences for the regulators. Do you think there's unintended consequences in letting some of these new players in, whether it's an entrant from outside of the U.S., a player such as PayPal that today has a bank partner? Like, where does this play out for the regulators?
So, for the past 10 years, I mean, the FDIC had been very stringent about not allowing deposit insurance for what they call niche bank charters. So they were bank charters that were for a narrow focus because they thought they were more likely to fail, more likely for risk of having their business model go kaput because they were so narrow. I think the regulators now have kind of done a complete 180, whereas they're no longer serving as kind of the gatekeepers.
Okay.
They're basically saying, well, you got a business model. It looks like it's probably going to be viable, or it could be viable. Your business plan looks viable. We're going to let you into the banking system and see what happens. And I think that's kind of an interesting approach. That's a lot different than we've seen in the past.
So for some of these, I think this raises the question around FDIC insurance, and access to the rails. So let's separate those two questions because they have very important implications in terms of what your actual business model is. Do we need to rethink how FDIC insurance works based on the type of business and business plan that someone puts out? Because it does feel like there are a large number of traditional banks that are now subsidizing those that might be taking on a much greater risk than before. SVB Bank would it being an example, even though it wasn't them taking on undue risk with technology or rails, it was they're taking on too much risk because of the concentration of funds they had.
Yeah. When I think, as I said, the FDIC had been very strict on who they were allowed to get a banking charter. Part of it is they're not only regulating the institution, but they're also regulating, as you said, the deposit insurance fund, which they have an obligation to protect and maintain. And, we've seen over the last few years, the last financial crisis, as you said, that there was a real knock on the deposit insurance fund. Everybody got insured, whether you were within the limits or not. And I think we do have to rethink how we go about providing deposit insurance. It is a very powerful tool. It protects consumers, but I also think it can mislead and kind of cause people to go into the banking business or want to be offering deposits for all the wrong reasons, right? Because they get that backing from the government. They're backed by the government.
Yes. Well, and the implicit consumer protection because they see the logo without reading the fine print. There's a bank behind it or what the limits are. The implicit assumption if, I am a large corporate depositor, I'll be protected because of my importance to the system and to the bank. Let's turn our attention to the rails. Should we be should we be opening the doors to who gets access to rails or should we limiting who gets access?
Well, I think we've seen the rail fight really for people trying to get master accounts at the Fed. That's been probably the prime, issue in the banking space over the last few years. It's been a lot of litigation because the Fed has historically really limited who has access to those payment rails and access to a master account of the Federal Reserve. It's not only just, banks. It really is just limited to banks, but now trust companies want them and a lot of other, non-FDIC insured type banks want them. And that's going to be a real contentious point. They've come forward recently with a proposal for a skinny master account that might have some appeal, which I think in some ways will limit the potential liability, the potential system risks while giving people some access to it. So I think we are seeing ways that the rails are being kind of moderated or the risk on the rails is being moderated, giving more access, but also making sure that we don't cause the system to fail because ultimately at the end of the day, that's all the U.S. has is a stable system. If our system isn't stable, we're not going to have a good financial services economy.
No, it's what sets us apart, really. So where do you fall on this stable coin journey of, does it fit neatly into how we think about the existing regulatory frameworks? Obviously, with the Genius Act and Clarity Act trying to put this in, but there still is a large part of stablecoin that's going to exist outside of the system. And, we're fighting over rewards versus interest rate, trying to reconcile what's in the system versus out of the system. Is that going to work to kind of have a translation layer, or do we need to kind of pull it all in or just understand it's going to be the Wild West?
Well, I think at least they're trying to get some regulation around it, but obviously innovation is going to lead regulation all the time, right? And the regulation is going to catch up over time or not catch up and have to change the laws. I do think that there is some, I value the stablecoin product. I see it as being kind of a cross-border frictionless payment instrument potentially at its best scenario. Is it something that, every bank should be jumping on? Probably not. But every bank right now thinks it's something they have to be involved in. I can't imagine we're going to have a situation where 4,400 banks are going to be offering their own stable coin, but who knows?
Yeah, we'll be back to the pre-Civil War era issuance of private currencies again. So as we wrap up here, and we think about the philosophical tension around regulation that you hinted at here, what do you think we could be doing better in the U.S. to both protect the system and the users of the system, that we're not waiting for the really bad things to happen as it relates to regulation? At the same time, we don't want to stymie innovation. Is there a right balance or somewhere you see that it's being done well in the world, or that you could wave your magic wand and say, this is what I would attack first to change?
I think it's a lot easier to do in a country where there are fewer banks. You've got Canada, which are very consolidated, banking industry with one banking regulator, OSFI. It's easier for them to implement change in the industry. Whereas in the US, we have such a fractionalized kind of system of regulation. I think it's challenging. I mean, we need regulators to coordinate, to work together. We need to basically try to limit the arbitrage Because ultimately, the arbitrage in some circumstances has basically led to what I would call a race to the bottom. And I don't think any of us want to be in that position when they're all racing to get to the bottom, because that's not going to help ultimately in the long run our financial services system.
Well, thank you, Jeff, for helping me wrestle through my questions of, do I want a bank or do I want a bank charter? Thanks for joining us today.
Great to be here. Thank you very much for having me.